Hello, I'm Marvin Barth of Thematic Markets and Seriously Marvin, and I'm joined by my good friend and longtime colleague, Mark Farrington of the Global Watchtower, the Dollar Watchtower, and the BoJ Watchtower. And we have a lot to discuss this week, Mark. I think we should definitely start with the Bank of Japan meeting this morning, and then reflect back on the Fed's decision earlier this week. I think there's a lot there to discuss. But then I'd like to focus most of the time on a piece that you wrote last week called the Dollar Upside Gamma Systemic Pressures. You raised some really interesting questions in there. What I thought was quite interesting is how aligned and different all at the same time our views are. And so I'd really like to focus on that because there's just so much that falls out of discussing that piece. But why don't you start with the Bank of Japan because you are very clearly the longtime BOJ watcher and expert on the topic.
Okay, thanks for that, Marvin. Good to see you today as well. Yeah, the BoJ meeting is, I guess you could say, still in progress because we're waiting on Governor Ueno's press conference, where hopefully there will be some, hawkish signals that set the market up for an October rate hike. There was not enough effort done during the month of September to get the discounting there to allow the BoJ to hike rates at this meeting without producing a shock, of which it's very wary, given the debacle last year when it surprised the market and end of July and caused the stock market to fall in August. So it was not a highly anticipated meeting from the expectation of rate hike, but they did continue with normalization. They announced the sale of ETFs, which they have been agonizing over for most of the year, both stock ETFs and real estate ETFs. And so that's the final piece of the globalization tack that they need to get on autopilot like the rest and have the unwind begin. So hawkish from that standpoint. But I think if we're going to try to glean a signal out of it, we had a two-vote dissension. So a 7-2 vote outcome for the BoJ is actually kind of a big deal because it's mostly unanimous and consensus, even more so than the Fed, for example. And it has ended up being what is now emerging as the little camp of hawks on the Monetary Policy Board with, both Tamura and Takata voting against, and importantly, citing what I think is the clear risk management rationale for doing it, which is upside risk to inflation. So Tamura, dissented back in December last year when the BoJ didn't hike in December when it clearly should have, and now he's dissented again. So I think that is a strong enough signal that October is now live for the rate hike. But I think focusing on risk management and normalizing as soon as possible because risks are at least symmetrical, if not skewed to the upside, is the narrative that Ueno needs to start adopting. So not from the contingent of just the hawks or the Deputy Governor Himino or something like that. We really need, Ueno to start to talk about his risk management concern for upside risks. Because what it does is it causes the yen to weaken after each meeting. And it's this consistently weakening yen that keeps headline inflation elevated and why you can no longer argue that it's transitory. Just because it's not core CPI, if you have headline CPI factors persistently overshooting for 3 years, it doesn't make sense to carve out the headline and look at core. So I hope that in his press conference, Ueda brings up his concerns about upside risks as well. And then I think we can consider this to be a productive meeting on the part of the Bank of Japan.
Okay, and I think we'll also get into the quantitative tightening piece as well. The Fed, I don't know if you want to start with them or you'd like me to. I mean,
I can give you my 2 cents. I mean, I was calling for 25 and done. and I hope that's the case. I don't think you can definitively conclude that from what Powell said, but at least it's a possibility. And there's a few dots on the SEP that suggest also 25 and done because risk management, 25 basis points, push back on political pressure, and to give everyone a benefit of doubt. Because I think, unlike what the Fed does say about tariffs, the longer we go without tariffs manifesting as expected, the less likelihood that it will, because we all know that it's time that we needed for importers to adjust and choose alternative supply chains and negotiate discounts, etc. So I think the fear of a big bubble, a transitory bubble in tariff-related inflation has to be downgraded the longer that we pass without the signs showing up. So hopefully 25 and done. Those are my thoughts.
Well, I think I can summarize my views in a single phrase: train wreck. I thought this was an absolute disaster of a meeting. As a former Fed economist, I'm frankly embarrassed for the institution. My views, as you know, all year had been there was not a case for cutting rates this year, and that if anything, they were more likely to have to hike this year. Now, obviously, when Chair Powell at Jackson Hole, basically stated they're going to cut, of course, I have to pay attention to what they say, and we're like, okay, they're going to make another policy error and they're going to cut. So I do think that one and done is probably right, but given that they are just such a complete disaster in terms of any type of rationale or any type of anchor to their policy at this point. Um, I, I, I don't have a high conviction they're not going to continue to make policy errors and continue to cut. That does mean that they are going to have to hike significantly in the future, right?
Yeah,
And
yeah.
so, 1 year rates, I think, are a very, very clear pay. Like pay, 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 pay. A very strongly held view there.
Yeah, well, the fact that they have their risk management hat on rather than their fear of recession hat on is good because when you have your
No,
risk
no, no,
management,
but I totally disagree with that point. I think,
yeah.
oh, yeah, like risk management would have argued not doing anything this meeting, right?
What I meant by that, risk management means you can change tact quickly if you're wrong. So if you believe that there's a recession fear, you're possibly going to dig your heels in. But if you say risk management, I don't know, the data are still too difficult to interpret, you can legitimately change your mind in
Yeah,
this
but
meeting and say, okay,
I'm just saying that's part of why I think it's a complete train wreck, right?
yeah,
Is that those were the words that came out of his mouth. That's
yeah.
not what the action, the policy, the justification, anything else said. It is clearly recession fears. It is clearly their
Insane to have
absolute.
recession fears. I mean,
Huh?
honestly, it's insane to have recession fears. There,
It is absolutely insane. And this is
yeah.
why I mean it is absolutely not risk management. I mean, there is
Okay.
if this is their version of risk management, they need to go study the definition,
Okay, I
right?
got you. I got
Um,
you. Okay.
so
I
like
said inflation. I think if you're an inflation targeting bank and you say risk management, it means exactly what you're saying. But I think it's just more and more evidence that the central banks that claim to be inflation targeting are not inflation targeting central banks anymore. They just continue on with the theatrics, but they are not inflation targeting central banks anymore.
I, I don't know about that. I just wonder whether they just completely don't understand. And there is, I think, a legitimate worry here that they are uh, losing their focus on inflation and over prioritizing, the supposed other side of their mandate, jobs over that. The reason why I say that this was clearly not a risk management decision is that risk management, whether you're talking about inflation targeting or otherwise, that's irrelevant in this case. You have an economy that every single indicator is telling you is doing extremely well. investment is off the charts for all the fantasies about tariffs were going to cause all this uncertainty and stop investment. Absolutely no evidence for it.
Yeah.
Investment numbers have been you know off the charts, fantastically good this year. Core durable goods orders continuing to show that that's continuing. You look at announced investment plans, they are off the charts. The US is attracting more than 75% of the world's total announced investment, and it's over $2 trillion in announced investments coming in. um, there is no sign that you're not getting super strong capex in the US. Then you have retail sales. Retail sales were growing at a 9% annualized average rate in the last 3 months. How is that not solid consumption growth? And then the only weak indicator you have is labor. But there's a very good explanation for why that is, which he even raised in the press conference, is that, hey, actually, the number of foreign-born workers has fallen by 1.5 million people. There's maybe a supply constraint on labor. We're
Yeah.
not really seeing this elsewhere. And then on top of that, you have the inflation has continued to re-accelerate again, as I've been forecasting. And, I do think that, inflation is a real concern here. They do not have it under control. And a risk management perspective would be that you'd say, well, gosh, given that we don't know why labor is weak, but we have an explanation for why it might be associated with supply rather than demand, and everything else is telling us we should actually have higher rates, risk management would say, at best, we sit here and pause. You do not cut.
Yeah.
Absolutely not. That was
No,
a,
you're right. They could have easily paused. I'm just happy that it was characterized as risk management rather than fears of a weakening economy. Because if they had really characterized, a bit of disruption in the labor market as evidence that the economy was in danger of sliding into recession, for me, that would just have been comprehensively wrong. So I was celebrating that minor nuance, but I take your point. There's
well,
a lot
look,
of data that's not
then
being
then
properly
if
weighted.
if that is the way you're going to read that, then that's actually a more worrying sign, and it does um, uh, emphasize your point about the lack of focus on actual inflation targeting. If you're saying that your risk management is to, well, there's some sort of risk associated with employment, so we're going to ignore every other signal, including what's going on with inflation, and not worry about risk management of inflation, then that's telling you that they're not concerned about inflation. And so I think this is going to
Yeah.
get to, I think, some key issues that I really want to talk about in terms of the dollar gamma piece. But the underlying fundamental piece of that is if that's what your central bank is saying, you should be very worried about term premia, right? Because,
Absolutely. I don't know if you read Bill Dudley's opinion piece in Bloomberg today,
I
but it
did
was
not.
interesting. He made the comment about the now surfacing, third mandate of the Fed, thanks to comments from Maron about controlling long-term interest rates, and he made the point if you focus on the first two pillars of the mandate, the third one will take care of itself. Well, actually, the inflate most of the inflation targeting central banks around the world, they don't have the two pillars. They usually have one, and even ECB doesn't even respect his second pillar anymore. So there's supposed to be one needle in the compass, back to the good old days. And if you take care of that, then pillar number two and pillar number three both should take care of it
Yes.
themselves. And the Fed is not taking care of pillar number one, which is supposed to be inflation. So this is why I'm arguing they're not behaving like an inflation targeting central bank, and nor is the BoJ.
No, and by the way, that's a fantastic point. I hadn't read Dudley's piece, but when I go back to when I worked at the Fed, 20 plus years ago,
Mhm.
it was consensus within the Fed leadership and throughout the institution that, yes, quote, we legally have a dual mandate. But
Mhm.
what we learned in the 1970s is that if you screw up the inflation one, you're definitely screwing up the second mandate. So you should only focus on inflation and employment will take care of itself. If you, as a central bank, set stable prices for the economy, employment will take care of itself. And exactly to that broader point that if there is this, complete misfocus on government financing costs, then
Mhm.
you know focus on inflation will also take care of that for you. It will
Eventually.
bring
Yeah,
down term premia. What they're doing is actually dangerous for term premia and long run financing costs,
exactly.
as
That's why I brought
well
that.
as for employment. Allowing inflation to get out of control again is only going to come at the cost of future employment. There's no way around that.
There will be an easy end to this, fixation on the long-term yields potentially in the next 2 quarters. If I think mortgage rates are down to 6.25 or something like that at the end of this month. If there isn't a refi cycle, which is what, Miran's mission is from Trump, go in there and help me get a refi cycle because the refi cycle will not only, balance growth in the US, it'll be good for voters in the midterm election next year. But if let's say, if we don't crack 6% and we just sit here at 6.25 on mortgage rates, I don't think there's going to be much of a refi cycle. And then people are going to understand that the Fed has a lot more work to do in order to ever get long-term rates down again low enough that we have these big refi cycles like we had over the last 15 years you know, when we eventually get to this dollar gamma thesis, where we had extreme use of monetary policy as a lever one time in history, and hopefully that regime is now over.
Well, let's get to that dollar gamma piece because I do think, as I said, it raises a lot of interesting questions. So, why don't you, for those people who haven't read it, just give a brief synopsis of what you wrote there.
Okay, sure. So it's arguing that we've had a regime change, yeah, and I think everybody loves a regime change, and I do too as a portfolio manager. When you get a big regime change, it gives rise to a lot of interesting investment themes. So I started from that perspective, and the regime change that I was focusing on is this end to monetary extremism, which I define the beginning of the monetary extremism from the measures taken between 2011 and 2012. And then this period of 2014 and 19 is more of like the policy divergence between the US and the rest of the world. And the second point of that regime is this advent of elevated geopolitical risk. So we had, some initial events in 2014, 15, 16 that kicked off geopolitical risk as a concern. But now I'm arguing we're in a period of just elevated level of geopolitical systemic pressure that just puts pressure on the fragilities in the system continuously. So it's a different risk environment altogether. And then finally, there's been an overlay of a tech supercycle with US leadership, which has a particular dimension. And that has led to this unsynchronized, both macro and policy story of the US relative to the rest of the world. So not so much US exceptionalism. I don't like that term. I don't like how it was connected to the historical term. It's policy divergence. And we used to use this term back in 2014, 15, 16, when the dollar was just really on fire. It was just policy divergence. US was the first to exit after the global financial crisis. It was the first to raise rates. We had the taper tantrum. Meanwhile, Europe very slow to enter QE and Japan stuck in deflation. They were always lagging behind. So it was macro and policy divergence that gave the dollar such a lift. And I would argue that that's still always a driver of currencies because it's a relative price. And so that we're now in a new regime that will produce the same sort of dollar effects and long-term risk premium in the yield curve because of policy divergence.
Okay. I mean, you didn't quite get to why you call it dollar gamma, and I think there's also some
Yeah, so
explanation
the dollar gamma comes from the fact that I
aren't
would argue
necessarily.
incorrectly the market has attributed too much of the geopolitical pressure as being US centric. You know, for sure, Trump's election and his very rapid fire implementation of his campaign pledges in the first 6 months of 2025 is the most disruptive factor in 2025. But the thesis about rising systemic pressure is country agnostic. You know, US is just another one of the countries in the system, and therefore the pressure isn't nationally US centric. And so the market, in my opinion, has erroneously understood this and sold US dollar and treasuries at the long end on what they think is a US risk premium. And I'm arguing that it is a system premium. And so it's like the US dollar and treasury and the treasury yield curve have been a balloon held underwater. And the next event that happens that isn't US centric will make it clear that it's systemic. It's not US oriented. And I think the dollar then, you know, spikes to the upside with this, you know, gamma like behavior. And I think the yield curves can have that same steepening effect with a gamma-like behavior if inflation misses. Like, for example, as you said, if inflation reaccelerates right here, the steepening will be incredibly rapid. So I'd say that's what I meant by this idea of upside gamma. These traditional safe haven flows are there. They've just been also offset a bit by this erroneous thesis that we have a US centric breakdown in geopolitical stability. I'm arguing it's a system wide, and the US, like always, is the most active and proactive. So it looks like it's being US driven, but it's just US reacting to the system pressure as well. China's reacting to the system pressure, Russia's reacting to the system pressure, so is India and Brazil. It's just the US gets all the attention.
Yeah. Yeah. So, what I found really interesting about this piece is that there's so many areas of alignment between us, and I'd like to explore each of those, but also really interesting differences in there in terms of how we get to our alignment. Um, and then I think it also raises some interesting questions about where we're going in market. So in the alignment, like, I think both you and I are much more positive the dollar than the consensus. And so, directionally there's alignment there. I also, to this gamma perspective, which, for those people who are not like options people or whatever, basically just think about this as a snapback. That
Mhm.
there's some sort of snapback. I think the potential for a snapback is high. Um, and that the cause for that snapback is another area of alignment. I would phrase it maybe a little bit different from you in that I think of it as there's a divergence between the market narrative and what I call themes, the underlying fundamentals driving the overall market. And so this divergence has happened, but you cannot have narratives diverge for that long before they come crashing back to the fundamentals. And
That's
so
right.
I think we're both aligned on that. The appropriateness of wider spreads, um, given the manifest increase in all sorts of risk, monetary risk, geopolitical risk, political risk, economic risk, I would throw in there as well, and uncertainty over all those things means that you should have wider spreads everywhere, and that's definitely appropriate. Um, and then I think the one of the things I found really interesting as a source of alignment that was something I hadn't thought of. And so it was very revelatory for me to read the piece. But I was like, oh yeah, actually, absolutely, this exactly fits with my thesis. But I hadn't even realized it. Was this point about the narrative masking what may be a underlying fundamental shift. So we've all been so focused since Liberation Day on this, anti-US, anti-dollar trade that you may not have noticed that actually maybe that's holding it would have been a lot worse had it not been that there was a fundamental move that was actually like, oh, actually in this environment, I want to hold more dollars. I want more treasuries, right? So I think that's a really interesting one to explore. What's also interesting to me is the differences between us that you focus a lot in the piece on um, uh, the shift in monetary regime and this move to quantitative tightening. Um, and I'm less convinced by that, in part because I have very non-consensus views on the impact of quantitative easing and also quantitative tightening. I do think there is a regime shift there. But I think it's about the political realities in the background about what quantitative tightening means this time and what it means for
Mhm.
the long run of central bank reaction functions. And then I think there was another difference we had around, the role of non-banks in all of this. But this leads to a bunch of different questions. So one is, I think, where are the bond vigilantes? I mean, for as much as bond spreads have risen, given the magnitude and the just array of different risks that I think we're facing, why has there not been more of a rise in,
Mhm.
say, long end yields and increase in term premia? Um, there's another whole question, which is I think we both agree on this potential for a significant snapback in the dollar on some event, unnamed, not clear what it's going to be or when it's going to be. But who are the broader sort of winners and losers within that snapback, both across asset markets and, say across currencies, like, how do various EM and developed currencies fit in there? And then I think the final thing that's an interesting question here is in the background, there's this underlying question about what does this say about the dollar cycle and where we are in the dollar cycle? If we are both saying effectively we're still positive the dollar in trend and expect some sort of snapback,
Yeah.
this is in the context of a dollar um that has come off a bit but is still near cycle highs. And this is a particularly long dollar cycle. So what ultimately sort of sounds the bell on the dollar this time? So we should probably dig into some of those alignment issues because I think those we can cover pretty quickly. But I mean, just in terms of that, did you have any sort of thoughts or response to how I took the piece and what I thought was interesting, or was there something I missed in there that you liked?
No, I think, like you said, this piece touches on a number of topics, so it can give rise to a lot of discussions on the various dimensions of the thesis, and that's what idea generation is about. I've hatched this thesis on regime change, and I'm fleshing it out for the first time, and I will be modifying it as time goes along as well. But the two definitive points, which I'm unlikely to modify, will be, the geopolitical systemic pressure. I mean, we have crossed the Rubicon on geopolitics now. We have a kinetic war with a nuclear power, which we have never had before. And we have, 22 months, I think, of quantitative tightening across five or six major central banks now, which we've never had. And we have democratic institutions undermined and population having lacking trust in them for the first time in the post sort of 90s world. And we also have like the highest allocation to risk assets, both the household and institutional level. So there's a lot of things which are not debatable, and they all kind of point in this same direction where the world is positioned, still positioned for the what was achieved during the 90s and the noughties and the last first half of the last decade, which was first global peace, and then secondly monetary extremism. And while the thesis on both of those has now expired, the positioning risk is only just beginning to be shifted. So, like household ownership of equities is still like the highest it's ever been. I mean, from 2005 to now, it's gone, from in the 30s to, in the mid 40% now. And that's even in terms of percentage of their wealth. That's even with the rising housing prices as part of their portfolio too. And for institutions, if you look at traditional balance funds, institutional balance funds have also gone from, sort of 36, 38% allocation to risk assets to something much higher, more than 50 in some cases. So this was driven by the monetary extremism. The whole, consensus on QE as a monetary tool was the transmission is not necessarily an increase in credit, maybe a reduction in lending standards, but not necessarily increasing in credit growth. It was about the portfolio channel. Well, 15 years of QE worked. Everyone adjusted their portfolio channel. Everyone owns more equities, private equity, real estate, spread product, EM, etc. So we're at the apex of that. We haven't even begun the reversal. So I feel pretty confident this is an early call on the regime change that we now need to monitor. And I use QT as a nice timeline because that's a good definition of the end of monetary extremism. It doesn't mean that they've adopted something close to, a discipline, inflation targeting regime, but they're trying to run down the balance sheet and minimize their risks. And in terms of the geopolitical pressure, the list of unprecedented events couldn't be higher than it is right now. I mentioned the number one, which is a kinetic war with a nuclear power, but also we're well past the peaceful rise of China thesis, and now we have China leading the revisionist camp. So the background factors, in my opinion, are not very debatable in terms of these two big driving theses. On the nuanced things and the actual
You've already given me way too much to respond to. So let's let's break this down
Okay.
a little.
All right. I was just going to finish on the point about bond vigilantes. I would argue that the vigilantes are out there. They're just not only bond. There are other things like the move into gold is a fiat vigilante move. The more than 50% of all the countries in the world raising their defense spending is a vigilante move. And so I think that there is all sorts of evidence of people increasing their buffers, increasing the liquidity preference, becoming more defensive. It's just not only manifesting in terms of what we used to traditionally call the bond vigilante, rejection of the policy status. So let me finish there. You go ahead, jump in.
Yeah, no, well, actually, I'm glad you did raise that because I mean, one of the things I would push back on is that I mean, there were several things there that I get to some of my differences. But one is okay, so household ownership of equities. You know, look, we've talked before about you're a long time you were one of the early investors in emerging markets. Most emerging market investors today don't recognize this because they're too young. But in the old days, when you were worried about a emerging markets central bank policies or prioritizing debt repayment
Yeah.
over inflation. There was a very clear play. You buy equities because equities go up with inflation, bonds get destroyed. And
Uh-huh.
so one could argue, I'm not saying this is absolutely the case, and I definitely think there is definitely a risk view, but one could argue that actually that is pretty clear. And to your point, if you're also saying, oh, this is also happening with gold, although the extent to which how much of that is driven by just China, Russia, and retail India recently is a question, but there's definitely been an increase in people's holdings of gold. That actually kind of fits with this. Oh, well, we're actually just very concerned about fiat. To your point, the rise in Bitcoinism, all of these sort of things all fit with that thesis and maybe do help. I would also say that, like, look, one of the key sort of differences is around this quantitative easing, tightening point. I mean, first of all, I would say that, I think you're giving the central banks too much credit in
Mhm.
terms of, moving towards quantitative tightening. I think, Bill Nelson at the Bank Policy Institute, whom I used to work with at the Fed many years ago, makes this point very well. Like, the Fed still doesn't get it. Their projections for what is the necessary level of reserves is like, three times what it really should be. And that they're
Yeah.
still pursuing this floor mechanism for managing rates. When they talk about quantitative tightening, they're talking about, tinkering on the edges. Whereas I think to the underlying issue that I referred to earlier, which is the real regime change, is the change in political perspective here. And it does seem very much at odds with the Trump administration pushing for lower interest rates. But, you look at Scott Bessent's op-ed, and the broader thesis of populists all over the place is that no, we want our central banks out of our markets. We want them to stop being politicizing by buying all this stuff. They should be out
Yeah.
of these markets and they should go back to what they're supposed to be doing, which is, you only have just enough reserves to manage system rates, right? Um, and so I think you're giving the central banks too much credit, and well, let me let you respond back, because then I think there's a much
Okay.
more fundamental issue about quantitative easing and quantitative tightening, which, again, as I said, I'm very different from certainly markets and probably you on this.
Okay, I would argue that there's two important channels that are in play as a result of QE versus QT regime. Number one doesn't even really need to involve the central banks because, having spent 30 years of my life, managing funds, both leveraged and unleveraged, I can tell you that there's a large percentage of fund managers, potentially 60% of fund managers out there that are not value-based investors. They're either momentum or using systematic factor models, where everything is running off of capital flow, leading indicators, etc. And they bought risk assets on the announcement of QE and of the size of QE, and it was all coincidental buying before the balance sheet even made its first purchase. And so there is a tremendous amount of price change and asset allocation away from cash and risk free to risk assets that was traded on the event. And so they are not fundamental. They don't need to look at the impact on the real economy to validate where the policy is working. They don't need the banking sector to be more healthy. They're just trading the policy announcement, and they accept that the message that's being communicated to them from the central bank authority, which is supposed to be the most conservative participant in the market, is that please go out and take risk. And so they duly did that. So now that you have the central banks, theoretically projecting the same message in the opposite direction. And I say theoretically because they're both doing QT on the balance sheet and cutting rates at the same time. So if you're an investor looking for a Q from the central bank at the moment, you're struggling. So that's point number one, is there's a lot of asset price that's just based on the announcement effect and what the risk environment has been communicated. The second point, in my opinion, relates actually to the real function of QE. Um, Excess reserves are not only a concept for the banking sector, they're also a concept for the non-banking sector and the high-grade corporates. And after the global financial crisis, everyone did the same thing. They built up huge precautionary cash buffers because the future was unknown. And that high level of cash buffer in the non-financial corporate world functioned exactly like having high reserves in the banking sector. Is that when you're over provisioned for cash and reserves, you can go back to risk taking in a highly risk environment because you're not dependent. You've reduced your dependency. And so this is what I feel QT. I use the analogy and the Substack piece I put out as the frog boiling in water because it happens very gradually. But I think very gradually, risk-taking behavior will be affected by having lower cash buffers and less excess liquidity. If the real economy is very strong, they're going to be risk taking. But if there's any doubts or any wobbles, I think they'll be very quick to retrench because they no longer have that courage that one has when they're sitting on a huge cash buffer. So those are the two factors that I think a QT regime world is different than a QE regime world.
Yeah, so look, I think this gets to my sort of fundamental problem with most people's view of quantitative easing and quantitative tightening is that, the consensus view and the narrative around that, in my view, isn't borne out by the facts. So, you can start with the um, uh, well, let me say first, if I have a very clear fundamental economic explanation for all of the things that happened, then the case or proof of um, QE causing those things has to be overwhelming
Yeah.
to overrule the fundamental case that the same thing wouldn't just normally have occurred without QE,
Yes.
right?
Fair point.
And that's where I sit, is I see the arc of economic developments over the last 15 years of QE
Yeah.
as very supportive of the economic argument. And I not only don't think that the evidence for QE being these cause is compelling, I think we actually have clear evidence that it's false,
Mm.
right?
Fair
Um,
enough.
and so, what was the so what is that sort of economic arc? Well, this goes back to something that I think, and we hinted in the last podcast that we're going to have to go back and redo the global financial crisis and its actual causes.
Yeah.
But one of the key drivers, I think we both agree on that, was China's massive subsidization and overinvestment in capital,
Hmm.
which drove down the marginal product of capital everywhere in the world, right? So people talk about, QE causing low interest rates or the quote savings glut or things like that. No, it's if somebody has massively overinvested in actual fixed capital in the world. They've driven down the return for anyone else in the world to invest in fixed capital. What has to happen to real interest rates fundamentally throughout the world? They have to collapse. That's
Yeah.
what happened. And
Hmm.
central banks chased those lower. They weren't the cause of it, they were reacting to it. And same thing with QE. And then, one of my key theses has been that, we had this advent technological change, which fits very well with your point about this tech cycle, right? That actually has driven this localization movement. And now there's something to invest in that has raised real interest rates. And that's what's caused, again, central banks to chase them back up. The central
Hmm.
banks, if you remember, they were telling us, no, we're going to be on hold forever. They got it totally wrong. They
Yeah.
had to chase real rates higher.
Yeah.
Um, and so these were all economic phenomenon that drove these things. If you go back and look at what was the evidence for quantitative easing having in sort of impact, they looked at these, high frequency market movements on either announcement effects or buying effects in markets.
Yeah.
And of course, that's going to drive in the near term. You're going to have a liquidity. event, you're going to drive price, demand, short-term demand away from short-term supply in markets. You're going to have a price effect. But then those things, you know, normalize through time. You have that they basically mean revert afterwards to what are the fundamental values. And, I think one of the clearest evidence of that was what happened in the taper tantrum. If you
Yeah.
had believed what the academic literature was going to say about QE, that it all operated through the portfolio balance channel,
Hmm.
in the long end, then what you should have seen is the most violent part of the move during the taper tantrum and thereafter should have been in the long end. But no, it wasn't. It was exactly in the belly of the curve where people's expectations for monetary policy rates were. That's what moved. It was the 2 to 5 year sector of the curve moved the most, right?
One caveat to that point, though, is the taper tantrum, the biggest, I want to say, the biggest loser in that was EM. So and that created a flight of quality into the long end of treasuries because all of the long end of non-treasury debt markets got absolutely crushed during the taper tantrum. So this is my point about sometimes the safe haven flow is there and it's obscuring the underlying fundamental force. And this is one of those cases. The taper tantrum was largely viewed as an EM event, not a developed market event. But otherwise, I agree. It is the most powerful signal that the bank could make that it was changing its monetary policy direction. So of course, the belly of the curve should discount that.
And the other point is, if the Fed never did, or another central banks didn't do these studies because I don't know whether it's A, they wanted to justify what they were doing, or B, they don't think about it in sort of market risk spread terms the way I think of they.
Mhm.
But all their QE analyses, those short-term analyses showing that, oh, see, it also raises equity prices and it raises corporate bond prices and all of these things. The reality is that if you actually take out the real interest rate effect that was going on, the change in the discount rate, which
Yeah,
we talked about as being caused by the short-term dislocation,
yeah.
and actually the equity risk premium rose during each one of those instances. Corporate bond spreads rose. They did
Mhm.
not fall. So it had the opposite of the effect that they claimed in terms of portfolio balance. And the reason why I raised that is, you made this point about we've had 22 months of quantitative tightening here in the present period. If QT was such an important driver of markets, why are investment grade corporate bond spreads at all-time tight? All time. Never been this low before. Like, oh,
Well,
somehow
yeah.
I'm thinking something else is going on.
Well, I think okay. There's a you raised a lot of very important points there on QE and also the genesis of the problem from the global financial crisis. But just on the tightness of spreads, and why look, I think the people who try to write, academic papers, 1 year after events are just begging for punishment because, as you said, it's just announcement effects. But I think one of the reasons spreads widened during aggressive QE is because, non-treasury paper were not going to follow the curve down lower because they have a whole different set of fundamentals that they have to discount. And the same is true now. The increased supply of treasuries that are on the market are pushing up, but the corporate supply is running at a different pace. And so the spreads compress. So some of that supply demand driven rather than
Yeah.
risk analysis. But getting back to the global financial genesis, you reminded me of an important point. It wasn't just QE. We had this conversation before. 2011 is this year, in my opinion, when the Fed and then as a result, a number of other central bank peers who looked to the Fed for leadership, they all crossed the Rubicon and did incredible things that could not be put back in the box afterwards. So QE was one of them, and it was QE2, as you and I have discussed. Quantitative QE1, right after the financial crisis, made sense because liquidity had seized up in the interbank market, and that's the purpose of providing QE. QE2 was when they first imagined that, X number of percentage increase in the balance sheet equals X percentage of a rate cut.
Yeah.
And that's when it was wrong. But they also did Operation Twist. They put in dollar swap lines. They did coordinated FX. And there was this holistic approach to crossing every previous conservative limitation they had that transmitted around the world, and in my opinion, influenced China. I don't think China would have done the type of monetary stimulus that it did if it hadn't been just validated by, the primary gold standard in terms of central bank conservatism in the Fed, and also, one of my important points about global financial crisis is it was not just interbank liquidity and it wasn't derivatives markets that seized up, is trade finance seized up.
Yeah.
Global trade finance. This is when we started to short all the commodities and short all the EM stocks because trade finance seized up. And this is what China got involved in. And unbeknownst to most of the world, like 85% of all of Latin America's trade finance was coming out of like Wells Fargo and Bank of America. And, 90% of the trade finance was interbank in Hong Kong. And that had seized up, and China suddenly couldn't export or function. And so, as a result of the global financial crisis, we have had this decentralization away from a US centric banking system. And now that we have this decentralization in place, the system is a little bit more robust and not as affected by US QE and QT decisions, because now trade finance is completely independently managed. And I would argue that the whole move into crypto and decentralized finance is also about decentralization away from the systemic risk of this concentrated core source of liquidity come from the US banking system. And within crypto now, they have their own flight to quality. The flight to quality isn't to fiat or US banks, it's to stablecoins. So stablecoins is the flight to quality trade within crypto, so you never have to leave
Yeah.
your decentralized exchange. So I think the QT is definitely not going to play out the same way that QE did in reverse, because now we've had this big decentralization and this de-risking of the world relative to the concentrated too big to fail US banking system. But it's all still there. You just have to look a bit harder. The risk behavior is manifesting, but in different places, and this is what the thesis is about. Is the US yield curve is incrementally steepening, as all sovereign curves are. And there's one chart in my publication, which I don't know if you saw, which is generated by the San Francisco Fed, showing the decomposition of term premium between, interest rate expectations and inflation expectations, and then the residual. And my argument is that residual component is rising, and it includes a lot of factors, not and one of those is geopolitical risk, and the other can be, Fed independence or
Yeah.
fiscal risks, etc. But that's the way I think of it: is that residual is rising because there are so many other locations that the risk will manifest now.
Yeah, I don't have a lot of faith in those term premium models. That's why I tend to just look at the long-term spreads, and those have gone up, and I think that goes back to this point of alignment, that we are very aligned on. There are so many different things that should cause you to have preference for the front end versus the long end, that those
Yeah,
term premiums should be rising, and I think we're seeing that. I
yeah,
I think we've got just a few minutes left here, and I do want to focus on what are the sort of key um, takeaways from this. Yes, I would argue that diffusion, concentration, um, is a good thing that has lowered many risks. I would argue that's mostly in the US dollar space, however, which is one of the reasons why I think there is sort of why I'm more positive on the dollar, and why you're going to get snap back to the dollar if you have a serious risk event. Um, and so I do want to come back to what are the sort of winners and losers in that great reckoning, as I think we might call it, where the narrative collapses into the fundamentals. That this idea that, the US is the source of problems, which, was sort of the Liberation Day reaction, rather than, I think, as you and I saw it, which is, oh, you guys are just waking up to the world is really messed up, and and that the post-war liberal order died a long time ago. Wow. You're selling the wrong asset. When that reaction starts to come through and people do flee to quality in the dollar, which I think they will, um, uh, who are the winners and losers in this process, in your mind, both in terms of, sort of across asset classes and also across countries in terms of the sort of geographic space, currencies and different asset markets?
Okay. I included that GFSR panel from the IMF for exactly that reason, because they always, highlight in a geopolitical shock, the losers are the countries that have the least amount of buffers, international buffers like FX reserves or fiscal space, etc. And so, I think you can profile the losers. So the countries with the smallest buffers, the countries that have the unfortunate geographic position of being in a classic geopolitical choke point. And three, the countries which are, for whatever reason, strategic importance, etc., going to be forced into making this choice between US versus China. So because the way to avoid trouble is to not be chosen, at the moment. So a classic like this week, the UK had to receive the US on a big state visit where they're proposing, a massive $200 billion, tech investment strategy. But then the critical press immediately tried to see through it and say, well, they've just now become captive to the US. So the US has chosen who it wants to lock in first, and it's chosen the UK. And I would argue that they're going to build their sort of inner circle of trust and choose the Five Eyes countries. So I would say Nick's big Trump overture with its Mag 7 CEOs in tow will be Canada and Australia. So you're going to lock in your core countries with these huge investment strategies. So you can argue that they're winners. And then China will do the same. China will start to try to pick off non-aligned countries or countries that sit on the fence and try to twist their arms and get them to align with their new world order. And it will put stress on those countries, and those countries will need to have strong institutions and high international buffers to withstand what might be capital flight. And I think that it's not just the EM story. There are developed countries that sit on that same dangerous fault line. But we're going into a world where you need to be a large, mid-sized country so that you have enough strategic autonomy to say no and to push back. And you need to have large international buffers in terms of fiscal space and FX reserves to manage the volatility. But that's in an
I think
unchanged world.
energy fits in there as
Sorry.
I think energy fits in there as well.
That's actually an excellent point. I would add that having independence and energy buff as a buffer to reserves of fiscal space. Excellent point. The interesting thing, like I also like to list about what's different this time around versus previous regimes where we had this flip from you know easy financial conditions to tighter financial conditions. But this time around, oil is not playing a role. So energy prices are higher and there's high demand, but it's not oil. So that creates a different selection of losers and winners between the,
Well,
the energy
I mean that
space.
that that's exactly kind of my primary point about energy, and I think you could define it more broadly. I recall that GFSR chart that you were talking about, actually, one of the things that stands out is actually commodity producers in general do better in this environment. And I think that's absolutely going to be true here. But to your point about energy, right, is that like, look, the rise in energy costs in the places it's happened has been entirely self-inflicted.
Hmm.
It is Europe, and unfortunately for me living here in the UK, the UK just pursuing really stupid energy policy because the underlying fundamental price of the inputs is not high, whether it's natural gas, whether it's uh, oil, whether it's uranium. None of these are actually that high. It's
Yeah.
all stupid policy. Just going back to the question of winners and losers, we have it, it sounds like you're very much aligned with my sort of global bifurcation thesis that there
Yes.
it is going to be about winners and losers along those lines. A lot of volatility along the fault lines.
Yeah.
I think the sort of mean return or average return is going to be higher in the U.S. aligned sphere because it's a market-oriented system,
Yep.
as the Chinese system of overcapacity and non-market client-state relationships doesn't leave a lot of room for profit. That doesn't mean there won't be alpha opportunities within that space,
Yeah.
but as a beta move, that's just not going to be appropriate in my view. I mean, is that the way I should take what?
Yeah, absolutely. So I'm focused on the Western centric part of the bifurcation and what are their choices going to be in the next 5 years? Because I think I have a better ability to envision that, and I've kind of constructed what I consider like circles of trust. The US is going to have an inner circle of trust, which I've defined at five eyes, 9, 14 eyes, where it's going to share all its highest level tech, and it will continue to push for interdependence and in a way that globalization attempted to do globally. But this is highest level trust. Then the second ring of trust is you can think of more as like NATO, Indo-Quad, OECD, where interdependence will be allowed and opportunities will be tried, will be tested and adjusted. And then you have the next layer, which maybe I think you can consider a kind of Western Hemisphere, where even though the U.S. historically not invested and defended the Northern Hemisphere, it now seems to be an imperative, which I think is good news for Latin America. So
Yeah,
Latin America is kind of in a sweet spot. It, commodities as an energy as a sector, and the U.S. with an interest in increasing closeness and trust between the nations. But there's a few problems. China and Russia are already there as incumbents in some countries like Cuba and Venezuela, where they will need to be dislodged, and now Colombia from a different angle. So it won't be all peace and harmony in Latin America. But I think long-term goal is that U.S. is going to dial up its investment in South America and Western Hemisphere. And then the next ring out is non-aligned. And this is where I think it's interesting for countries like India. I think that China will make a play for India, will continue to make a play for Pakistan, it will continue to make play for countries like Egypt to try to persuade them, and we'll see how they respond. If they respond, it will be difficult. But I think in terms of you want to think of where capital has already flowed in, and therefore in a risk of a panic exit, India is in a dangerous position. India has to play its cards well, or it can frighten off the global risk-averse capital. And I would say like North Korea and Japan and Taiwan have that unfortunate geographic location.
you mean South Korea.
But they're all, singing to the same tune as Washington and investing and making the right choices. So capital flight is not a risk yet,
Yeah.
but China hasn't really dialed up its game there.
Yeah. You,
Countries in Southeast
you mean
Asia.
South Korea, but
So Southeast Asia, Vietnam and Myanmar and Bangladesh, those are three countries which I think are being courted from both sides, which will be interesting how that plays out. Indonesia is a bit like India, where it's a large, major economy and therefore has the potential for some strategic autonomy, but ultimately has to choose a side. And so it's going to have a lot of pressure put on it. And it might be one of those countries where it doesn't have the sufficient international buffers and it doesn't have the strength of institutions to cope well with the risks that it's about to take. So, that's how I'm kind of looking at the world and choosing winners and losers.
Which I think fits very well with the whole, sort of La Casa Nostra Americana thesis, right? Is that it's all about the circles of trust, and that's what
Mhm.
the sort of Trump bullying of allies has been about. It's like, look, if you're going to be in the inner circle of trust, you have to prove to the US that you merit that position. We've
Yeah.
given you it before. Now you have to prove you should be here because we need to be able to rely on you. And so I think that is definitely the right model to think about these things. Look, we're gonna have to close it off there because we've already gone over an hour here. So I'm going to thank you again for a wonderful discussion, and we'll come back to this again in 2 weeks.
Okay, thanks, Marvin. And next time you help me out on the energy front. You and your circle of friends on energy help me understand how we become an energy superpower in the US and still make profits in a private capital-owned world, okay?
Okay. Thank you, sir.